Welcome back to our Synergenics webinar series. Whether you're here live or watching the replay, we're excited to continue this journey with you. Here in part two, we'll be discussing financial strategies to reduce risk in collaboration with Providence CPAs who are dedicated to providing you with essential financial knowledge. Today's speaker is Bill Bennett, a financial architect with 18 years of experience helping physicians build wealth and achieve financial independence. Bill's an Oklahoma State University graduate with degrees in accounting and finance, and he's passionate about guiding healthcare professionals to make smart financial decisions. Bill's expertise in risk reduction is second to none, and we're grateful to have him here with us today. To get us started, I'll hand it over to Angie O'Day, Client Success Manager at Providence CPAs, and let her introduce the other panelists before we begin the presentation. Angie, the floor is yours.
Thank you. And thank you, everybody, for joining us today. We're excited to have you here. The additional introductions, we have David Auer. He is the founder of Providence CPAs and Physician Tax Solutions with over 35 years of experience as a CPA speaker, author, and business consultant. He has a lot of initials by his name. He holds a BSBA and MS in accounting from Oklahoma State University. JD with honors from the University of Oklahoma, and an LLM in taxation from NYU. He also has a personal financial specialist experience, chartered global management accountant, and a certified tax planner. Next up, we have Todd Hudgens. So thank you for being here, Todd. Todd is a certified public accountant and licensed attorney in Oklahoma, Texas, and Arkansas, actually. Todd has been actively practicing law since 2001. And is the founder of Horizon Attorneys and Counselors at Law. Todd formed Horizon to offer clients a unique legal experience and has been helping them navigate estate planning for many years, almost 2 decades. So let's talk about our agenda. We're going to be covering a lot today, a lot of great information. First off, we're going to start with protection, moving into a discussion on liquidity. Next up, diversification. And lastly, we'll talk about next steps and what that can look like. You guys. So going into the disclaimer, we do want to say that everything we're discussing today will remain in all 4 corners of the law, of the tax laws. So I'll hand it over to you, Bill.
Hey, thanks so much, Angie. And it's an honor to get to be here with you guys today and speak a little bit on protection. And it's not, the sexiest part of wealth building to discuss or talk about. But it's crucial and vitally important to make sure that, as I've always told my clients for almost 2 decades now, is that you should only have to build your wealth once. And in order to do so, you have to make sure that you have proper protections in place in the event of various unforeseen accidents or things occurring. And so as I dive into today, I think it's most important that we discuss what wealth what building wealth truly looks like, and why it is so important to protect yourself. You see, as somebody who's incredibly passionate about medicine as well as finance, this is the part where I like to explain how building wealth looks and what it looks like over the course of your career, your working years, because I am truly passionate about this. You see, I was actually pre-med in college, and due to some things that had occurred, personally, I was forced into taking care of my mother financially while I was still in undergrad. And so because of that, I knew that I was not going to be able to delay, getting what I call a quote unquote big boy paycheck for another 8 years or 12 years or so. And so because of that, I shifted majors. I shifted my major over into accounting and finance so that I could marry my passion for finance and my passion for medicine into one, and truly be able to educate medical practitioners all across the country on building wealth, but first and foremost, how to protect themselves. And so how does building wealth really work when we think about it in our working years? I call it this law of parallel paths. All right. And so um, each and every one of us are on this law of parallel paths, regardless of our profession. All right. And so one of those paths is a protection path. And with that comes liability, exposure to liability, premature death, or disability. And when we're talking about protection, what we're really discussing on that is, the type of coverage that we get, the amount that we have, the amount of protections we have in place, and how it's positioned. And if we get those three things right in regards to protection management, then we can build a very solid foundational financial plan. The second path that we're all on is this wealth building path. And obviously, this is the path that's, way more fun to talk about and way more intriguing. And generally, people have way more questions about it. But when we're talking about building wealth, what we're really talking about is capital. We've got to be able to have assets to be able to grow those to build wealth. But when we're talking about the wealth building curve, here's what it looks like. And so you can see the green arrow here. It's really slow and steady wins the race. Oftentimes in our early years of practice, we're still paying off student loan debt. We're not yet at our peak earning years, and we're also, I say, making up for some delayed gratification and maybe spending money on things that maybe we don't necessarily need, but we've wanted for the past, 7, 8, 10 years. And so because of that, this wealth building curve takes time. And what we know to be true working with thousands of physicians all over the country is that around 90% of this wealth building curve is not going to be realized until your last 7 to 10 working years. And so that means there's a significant period of time that we've got to protect this curve's ability to be able to be realized. And if we don't protect its ability to be realized, there is a possibility that we will not actually get to live the way we want to live in our future years. And so, working with the clients that I work with, here's what they've told me. They say, you know what? I would prefer to have 100% certainty of being able to get to 95% of my wealth building potential versus a 60 to 70% possibility of getting to the full 100. And so what does that mean? For most people, it may take away around 5% of your wealth building potential to get the proper protections in place. However, what you're doing is you're giving yourself the certainty that if something were to happen, if there was a lawsuit, if there was a premature death, if there was a disabling event, you have the certainty of still being able to reach 95% of this wealth building potential. Whereas if you skip out on the protection in the earlier years, you're really just giving yourself a possibility. Now, yeah, it's not going to take away from the money that you can save and invest for this wealth building curve, but you're still giving yourself more of a possibility instead of the certainty. And so let's dive in on these three areas real quick: liability, premature death, and disability. So when we're talking about liability, one of the biggest factors that we see take out high income earning physicians all across the country is at fault automobile accidents. Seems rather, minor, but when we think about it, if you were at fault in an auto accident and you caused severe damage, not just to the other vehicle, but if there were, some pretty substantial medical bills that piled up for the individual or individuals that you hit, as well as maybe some lost wages and other expenditures that they're going to have, you're going to open yourself to a lawsuit. And in the event of that lawsuit, if you don't have umbrella coverage, umbrella insurance in place, it can be pretty detrimental to your wealth building curve, because you may either have to write a check or settle for some kind of a monthly amount that you pay that family over an extended period of time. And so for pennies on the dollar, you can obtain an umbrella insurance policy. And these are sold in $1 million increments. And what's always encouraged is that you start at $1 million up to whatever your net worth is. And what this umbrella does, very simply like an umbrella, is this is liability protection over your auto insurances, over your homeowner's liability protections in the event that you are at fault in an auto accident or somebody is injured in your home. And this coverage stacks above and beyond what you actually have in liability limits on your auto and homeowners insurance. And it gives you the peace of mind knowing that if something were to happen, if you had that at fault auto accident, you have the coverages in place to take care of the individual or individuals or families impacted from that at fault auto accident. And it's literally for $1 million in coverage, it may cost $25 a month. It's very inexpensive. We just know it's not talked about that often. It's not marketed because auto and homeowners insurance companies, they market one thing and one thing only, and that is rate. So they very rarely are going to actually market any additional services that they can provide because, 15 minutes can save you 15%, right? So that's really all they worry about. So they don't market this, even though it is a necessity for any high income earner in our country. The second main threat that, can attack physicians is premature death. And so, obviously how we protect against that is life insurance. But when we're talking about a premature death, I see, families oftentimes when I'm working with a physician, everyone's situation is going to look a little bit different. But if there is a high income, a physician income of let's say $400,000 or $500,000 a year, and that all of a sudden, in the blink of an eye, goes away, that radically impacts the family's quality of life and their ability to continue to live the same quality of life and their surviving spouse and children to continue to build the type of wealth that you were building when the family was whole. And so life insurance is incredibly important. Often what I see in the financial space, though, is so many insurance agents are just selling a certain, death benefit amount. They very rarely actually pay attention to what the client actually needs. And so there's a formula out there called the HLV, the human life value. And this was actually a formula that was came up with right after 9/11. And it was the government had to determine, how are we going to compensate first responders' families who lost their lives, on that day. And so what they did is they determined the human life value. And so what this is this would actually take an individual's income and multiplies it out by the number of working years that they have before age 65. And it's capped at 30. But what this does is it gets you and your family as close as possible to replacing your income until the kids are grown, until you're at retirement age. And so when we talk about, getting our wealth building curve to completion, even in the event that we were to pass away, if you owned basically, your income over the next 30 years in a death benefit, that transfers to your family tax free. And that does replace you financially, so that the wealth building curve, the lifestyle of the family can stay intact. Now, I'm not saying everybody needs to own their human life value, but that is legally, you can legally obtain up to your human life value and death benefit. And like I said, every situation is a little bit different. When you're working with maybe households that have dual income coming from, dual working physicians, that may look a little bit different. But I do know a lot of the clients that I work with, there's a physician and there's a stay-at-home parent who doesn't work outside of the home. And so it's incredibly important that they own somewhere close to their human life value of death benefit, so that the spouse can continue to have the same quality of life. All right. The third main threat, and this is the one that we see most commonly plaguing physicians, is an illness or an injury that would prevent you from working. So right now, the statistic is about 1 out of every 4 physicians right now will have some form of disabling event that will prevent them from working for an extended period of time between now and age 65. And so, how we counteract that is with individual disability insurance. However, when talking about disability insurance, if you don't remember any part of my conversation today about disability insurance, remember this one quote: not all are created equal. I'm going to say it again because of the importance and value behind this quote. Not all are created equal. To be honest, for physicians and medical professionals, there's only about 5 companies out there that even have a quality disability insurance product for folks in the medical profession. Okay. And so when we're talking about not all are created equal, there's 2 main factors when deciding to purchase an individual disability insurance policy. The first main factor needs to be the strength of the company. You want to purchase disability insurance through a company that you know, based on their financial ratings, is strong enough to go through a storm if they have to pay out a bunch of disability insurance claims at the same time. So you're going to look at the strength of the company. The second thing you're going to look at is the strength of the contract. Okay. And so when we're talking about strength of the company, what we're really talking about is what's called a Comdex score. Now, a Comdex score is a composite of the various ratings that a company has received. See, there are 4 different rating agencies that are out there. Okay. Now, the Comdex score in and of itself is not a rating, but what it is it is a percentile ranking on a scale of 1 to 100, obviously with 100 being the best, in relation to other companies that have been evaluated by at least 2 or more of the rating agencies. And so this is composite. So what you're really looking for, you want to find companies that have a 90 or better Comdex score. And so that dramatically reduces right there. We're talking, there's almost 300 different insurance companies that exist right now that offer disability insurance nationwide. But when you start looking at Comdex scores being one of the main factors to look at, we're now starting to filter out a whole bunch of companies that don't have the financial strength to pay out a bunch of claims at the same time. And so now you're able to start filtering out so many, several hundred companies you can filter out just by looking at the Comdex score. All right. Now, the second component, the second factor we're going to look at is the strength of a contract. And so when we look at the strength of the contract, you're going to want to find a contract that is non-cancelable and guaranteed renewable. Okay. Now, this does not mean that you as the client can't cancel. All right. But what this does mean is that the insurance company, as long as you are paying your premiums, they cannot cancel this policy on you. Doesn't matter what happens to you medically. Doesn't matter if you're actually on claim in the middle of a disability, they can't cancel. There's nothing they can do. They are contractually obligated to continue this contract until you either stop paying premiums or age out of it. And so you want a non-cancelable, guaranteed renewable contract. The second main thing that you want to look at on strength of a contract is the actual type, the type of a contract. And so you have what is called an any occupation policy that's out there. You'll see where it says any OC in the PowerPoint. In any occupation policy, the way that that contract reads is that if you cannot perform the material or substantial duties of any legal occupation in the United States, then the insurance company is required to make a claim or to pay a claim. But when you think about that, what that contract is saying is that if the insurance company deems that you can go flip burgers at Walmart or go be a door greeter at Walmart, or flip burgers at McDonald's or whatever, then they do not have to pay out a claim. And I am not knocking those professions, but you did not give up your 20s and sacrifice so much money and sweat and tears and anxiety and stress to become a physician so that you could actually go work in one of those professions. But that's how any occupation policies read. They're very inexpensive policies, but the likelihood of them paying out is very low. They have a very low claim rate because the insurance company, especially for white collar professionals, they will find some form of an occupation that you can legally do, and now they don't have to pay the claim out. So what you want to look for on strength of a contract, you want to find a contract that is a true own occupation contract. And if you're take it a step further, you can get one that also is specialty specific. And so you want to find a contract, again, that's true to whatever your occupation is at the time of the disabling event. Okay. So if you're in family medicine and you cannot function in family medicine, the claim is payable, even if you can still practice in medicine, or maybe you can go into the academia side and teach at a medical school. So you can still actually work full time in any other occupation other than the occupation you were in at the time of the disability, and the claim is still payable. And then, like I said, specialty specific, right? So depending upon what your specialty might be, you may have some kind of a subspecialty that's very, very niche, very specific, and you want to find a contract that's a true ONOC with that specialty specific in it. The third main thing that you want to look at on strength of a contract is how they define a disability. Okay. How they define a disability. So most contracts that are out there are going to use the word, or they're going to use the word and. Okay. It sounds crazy. It's one word. And you look at me all puzzled and confused when I say the word and. All right. But here's what it means. Okay. Generally, they're going to say loss of time and loss of income. So if you cannot perform the material or substantial duties of your occupation as, let's say, a family physician, and you have a loss of time and a loss of income, they will pay a claim. Okay, those are not the best contracts, especially for where medicine is headed, and especially for any of you that is on an RVU contracts. Okay, you want to find a contract that uses the word or. It's literally, we're talking about an 80-page document, and we're talking about one word that's buried on like page 12, paragraph 6, line 4. But that can make or break the strength of the contract. So you want to find a contract that's going to define the disability based off of loss of time or a loss of income. Because let's just say you have an and contract, okay? And there's a very large company that's out there that sells physicians a bunch of disability insurance, and they have an and contract. But let's say you're on an RVU type of a contract where maybe half, 25% of your income is RVU based, or you receive an RVU bonus quarterly or semi-annually or annually. And let's say you're still working 1.0, but due to something as simple as arthritis, you are less efficient. You cannot see as many patients in a given day, and that impacts your income in a big way over the course of a year. If you have an and contract, it's not going to make they will not pay a claim. However, if you have an or contract, loss of time or loss of income, if 15% or more of your income has been impacted, there are insurance companies that are out there that will pay a prorated partial claim because of the or inside of the contract. And so it's incredibly important that you understand how they define a disability. And so when you look at, honestly, just those 3 areas on the strength of a contract, we're now filtering out over 100 more companies. And now what we're really looking at is there's only about 5 companies that are out there right now that have a great Comdex score and great contracts for physicians. Okay. Now there's other areas that you want to look at on the strength of a contract, partial disability riders. Obviously, you want to make sure the contract has a cost of living adjustment rider, right? I mean, this is an inflation fighter, something that's going to increase, the benefit's going to increase annually to keep pace with the cost of living. This one here, it's called a catastrophic disability rider. This is basically the simplest way for me to explain this. It's like long-term care on top of your disability insurance policy. Okay. And this is the cheapest way that you could actually obtain long-term care insurance. Long-term care insurance by itself is relatively pretty expensive. However, this rider stacked on top of a disability insurance policy is incredibly inexpensive. But what it is it's an additional benefit if you cannot perform 2 or more of the daily standard of life, right? And so what would essentially the same things that are necessary to qualify for a claim with long-term care insurance are the same things necessary to qualify to execute this rider. But this one is like, it'd be like $15 to $25 extra on top of your policy versus, a couple $100 every month. And this is something where you can get somewhere between 7 to 10 grand extra per month, in addition to the actual coverage on the disability insurance. And this is to help offset your long-term care costs. All right. Additional that you want to look at are future purchase options. These are incredibly important for residents, fellows, or folks that are in the military. So this is the option to purchase more disability insurance down the road without any medical underwriting. Because disability insurance is underwritten, pretty aggressively. And so they do look at a lot of factors when approving disability insurance because they do have such a high claim rate on disability insurance policies. And so this option right here, this future purchase option, becomes incredibly important, especially as mentioned, residents, fellows, military, giving the ability to acquire more coverage down the road when you are making more money, but being able to do so without having to take any more medical exams. And then the other one's the student loan rider, right? So if you still have student loans, I mean, this is something where you can get an extra $250,000, $300,000 of coverage that would be in addition to the actual disability insurance benefit. And so it's incredibly important. Again, especially for residents, fellows, military, folks that are still pretty early on in their medical practice who still have, very large student loan debt. This would be a rider that you would want to have on your contract, making sure that you have additional funds coming in to pay off those student loans, not take it out of the actual base compensation on the disability insurance. All right. That's the fun part of disability insurance. And like I said, really, when you look at it, you can break it down to only about 5 different companies that can give you the type of coverage that you need as a physician. But now I want to shift gears just a little bit and talk about liquidity. One of the things that I've noticed with a lot of physicians that I work with and have worked with over the years now is this inability to maintain liquidity. And so I want to walk through how most people's cash flow management looks. Okay. This is how most people manage their money. This is how I used to manage my money until I came across a better management system. Okay. But we make an income, and then that income goes into our bank account. It goes into our checking account. And then from our bank account, we have all of these bills. We have all these expenses that we've got to take care of, right? We've got our mortgage or rent, student loan debt, any other debt reductions. We've got our standard bills and utilities, taxes, our lifestyle. I call all of those items in red, I call those our burn rate. Right. I call it a burn rate because that's money that's burning. It's money that you literally burn every single month. It's never going to come back to you, at least not monetarily. Okay. And so, that money comes directly out of our checking account right after we get paid. And then with whatever's left over, we'll save or invest. Okay. That's how most people's cash flow management system looks. And that's how it operates. The problem is that, when you factor in our lifestyle, that's very much a variable. Most of those other areas of our burn rate are pretty fixed, but our lifestyle can be pretty variable. So if we've got extra money in the bank account, it may be burning a hole in our pocket, as my mama would say when I was growing up. That money's burning a hole in your pocket, and we end up spending it, okay, instead of saving or investing. So because of that, what ends up happening is we have very little discipline, and we have very little consistency towards what we are saving and investing on a month-to-month basis, because we're simply doing it with whatever's left. This becomes a spend first, save second management system. And so, from a book called Profit First, I learned a different way that we can look at our money and handle our money that can, especially over time, give us more consistency and more discipline towards our future selves. And so if we take that same income, but we don't put it in our checking account, we don't have it direct deposit in our checking account. Instead, we open up a different account, something totally separate from where we bank at, and we just call it our wealth building account. Now, there's nothing fancy about a wealth building account. It could be a high yield savings. It could be a brokerage account. I mean, it really doesn't matter. The wealth building account is not like a specialty type of, it's an account that you create that is not where you bank at. Okay. That's the easiest way for me to explain it. All right. But if you have all of your income direct deposited into that wealth building account, and then you pay yourself a salary into your checking account that's equal to your burn rate, what you're able to do is you're able to start holding yourself a little bit more accountable in regards to lifestyle, because you're still going to have mortgage, rent, student loans, other debt reductions, bills, utilities, taxes, and lifestyle. But because you're paying yourself a fixed salary every single month, equal to your burn rate, or maybe just a little bit over your burn rate, what you're able to do is create some stability there. You're able to create some consistency so that you can have these capital allocations from the wealth building account into your savings and investments. So what you're actually doing is you're creating this save and invest first, spend second management system. And I promised you that when you look at this over a 5 to 10 year period, I've seen it work with my clients for years now, but when you look at what this enables them to do for building wealth, it's absolutely incredible. When they just simply transition their management system of how they handle their cash flow from a spend first, save second to a save and invest first, spend second management system. All right. Then the last piece that I'm going to hit on in regards to building wealth is going to be diversification. All right. Now, when we talk about diversification, most financial advisors are going to be out there talking about diversification. And generally, what they talk about is portfolio diversification, meaning they're looking at an 80-20, 70-30, right? Like what percentage of your portfolio is going to be in equities, equities or stocks, individual stocks even, and what percentage is going to be in fixed income or bonds. That's generally how 98% of financial advisors, even financial advisors for high net worth clients, that's what they talk about. And I'm not saying that that's not important. That is a factor of diversification, but there's two other areas of diversification that matter, I argue, just as much, if not more, than portfolio diversification. And the first one is tax diversification. I think tax diversification, if we can get our taxes right, we can save and invest so much more money than we ever than we ever thought possible, and we can retire or not have to practice medicine so much sooner than we thought was going to be possible. Because when we look at tax diversification, there's really only three buckets that the IRS gives us, and that's a tax now bucket, a tax later, and a tax never. But when we diversify our savings and investing instruments into properly diversified across the tax now, tax later, tax never buckets, we can set our wealth building curve up for significant success by being able to do that. All right. The second thing, and I mentioned this, the portfolio diversification, right? This is what percentage or what ratio do you have going towards stocks and equities versus bonds and cash? This is the whole 80-20, 70-30, 60-40. Very important. Obviously, the younger we are, the more heavy that most of us will be towards the stocks and equities. But the closer we get to retirement or not wanting to practice medicine anymore, or not, then, oops, there we go. Then the more we would go towards a fixed income cash bonds heavy in regard to our portfolio diversification. And then the third piece, asset class diversification. You see, most physicians that I work with are considered accredited investors. And so legally, as an accredited investor, there are asset classes that become available to you and myself that most of the general population do not have access to. Okay. And so with asset class diversification, there are marketable securities. This is the stuff that you see that's tied to the stock market. Stocks, bonds, ETFs, fixed income, cash, whatever that is, the marketable securities. But you have this alternative class that's open to accredited investors. And there's a bunch of deals that are out there all across the country that have to deal with alternatives that we can access that the general public can't. And I think it's important that we actually have diversification across asset classes. That might be something that is private equity groups that are investing in something that right? I think it's incredibly important, that when you are investing, you're investing in things that. Maybe real estate, and some private equity groups that are out there that are doing some apartment syndications or commercial property or industrial property syndications, or maybe you just want to get into just industrial real estate yourself or commercial real estate yourself, or there might be private equity, where they're buying up different medical clinics across the country, and you're in medicine. And so that's something that interests you. That's something that that's something that you could read the reports on and you would actually understand. But I do think it's incredibly important to diversify across asset classes when we're building out our wealth building curve. And so again, on diversification, we want to look at the tax diversification, portfolio diversification, as well as asset class diversification. And so that's all I've got for you guys. I know Angie's going to take over and talk a little bit further about next steps.
Thank you, Bill. That was really great. Very informative. Okay, everybody, I want to talk about what our strategic wealth system model looks like as we partner with a client. There's a lot of building blocks which we start with. So first off, we're getting into tax minimization. As we work with you, beginning with a strategic tax blueprint, we want to also move into a level where you feel like you have control of your money, having a true understanding of how your tax planning needs to work for you. And then lastly, the top of this, the most important, and I'm sure Bill will agree, is financial independence. So as we get you strong in all of these areas, we hope to have you closer to financial independence sooner rather than later. And then also this information is featured in our book, or David's book rather, The Richest Doctor, which I'll cover here in another slide or two. So our process, if we move forward with you after this call, hopefully we'll have an introductory call, but we'll start off with a strategic blueprint, assessing all of your tax strategies, and then we'll move into onboarding and implementation. This is really important as we move in our journey with tax planning. And then lastly, year-end tax planning. So that's when it gets really exciting. So as mentioned, we'd love to have a 30-minute introductory call. This is how you can schedule with me. The QR code here, just scan it and that will access my calendar. We're also putting it in the chat, so if you prefer to just click that link, I really welcome you to make that call with me. I promise it'll be a fun 30 minutes talking about tax planning. So please take time to meet with me and we can talk about next steps. And then there's that great book again, The Richest Doctor. So you do have the opportunity to download the first couple of chapters and get kind of a taste of what we have to say and what David's advice could look like if you partner with him later. And then you can also buy it online. And I think we're also going to have the link on the website, or excuse me, on the chat where you can look into that book more. And questions. Let's open it up to any questions that we can send to Bill or David or Todd. Give everybody a couple minutes here. Okay, got a live one, Bill. All right, first question. You've touched on the concept of burn rate. How can someone assess their burn rate and make adjustments for long-term financial health?
Yeah, I think that's a great question. So here's the deal. I don't like the B word, budget. I don't like it. I never tell people to budget. I'm not a fan of the word. And the reason being is I think it's very much, I think the word budget actually kind of has a mindset of lack. And so what I've always encouraged my clients to do is really just live your life. Live your life for the next 90 days, but track and categorize what your expenses look like over those 90 days. And so if you can do that, now you're giving yourself the ability, the opportunity to really determine what your actual burn rate is, what your true burn rate is. Right? Because I think sometimes what people will do is they're like, well, I'm going to budget X amount for eating out. And then every month they're stealing from another account in their overall burn rate, right? Because they went over their eating out budget that month, and then they did it again next month, and then again next month. I think the main thing is we've got to be able to look in the mirror and just be honest with ourselves and just this is what my spending is, right? This is what it is. Now, if we need to make some minor cutbacks here and there, it's much easier to make minimal adjustments to lots of different things than to try to immediately just like reshape what our entire life looks like. And so what I found to be most successful with my clients, just live your life for the next 90 days. Live it the way you normally would without that nasty B word coming up and just, but track it, right? And there's some great software tools that are out there that can help you track and categorize what your spending is. Like I know for myself, like we use a rewards card for pretty much everything. or a couple different rewards cards. And so, we have like our cards and our bank accounts. We've got kind of everything linked into some software that allows us to categorize it and really see on like a pie chart, this is what our spending actually is. But so, yeah. So my piece of advice on that is live life the way you normally would and do it for around 3 months. And that'll help you truly determine what your burn rate is. Now, if we need to make some tweaks, let's make some minor tweaks to several different areas. And maybe we don't need to make any tweaks. Maybe just keep it right where it's at. And, you're bringing in 20 a month and your burn rate's at 9.5 and you feel good about that. Okay, great. Then let's work with that.
So takeaway is say no to the burn word.
Yes.
B word is bad. All right, we do have another question. How often should I revisit my financial planning strategies, and what key indicators suggest it's time to make adjustments?
And great question. Really good questions today. So, um, I will not meet with my clients any less than once a year. I think it's important that your planning be updated annually, or as significant life changes come, a marriage, a divorce, a lawsuit, a baby, um, purchase a new home, purchase a second home, sell a home. Big life events happening calls for an immediate, we need to meet and talk, even if nothing changes. I think it's just incredibly important, right? So, because when I'm working with my clients, a lot, when I first got started really working with physicians, it was because I was given an opportunity to teach financial literacy to a teaching hospital. And then that gave me an opportunity to then begin teaching financial literacy to a second teaching hospital. So the reason I bring that up is because the majority of my clients very early on were individuals that were residents. They were medical residents making 50 grand a year, still had 2, 3 years left of training if they weren't going to do additional training through fellowship. And so these are what I call lifelong clients. These are folks that I intend and hopefully they intend where we're engaged in this relationship for both of our entire working careers. And so with that means, okay, let's not just meet, once every couple of years. And so, I think quarterly, semi-annually, or annually, everyone's situation's a little bit different, but definitely no less than annually, and anytime there's a big life event happening. So, Todd, David, you guys want to add anything to that at all? Put you on the spot, but just figured I'd ask.
Well, my experience is it kind of depends on, the stage of life you're in. So, if you're up, if you're young, it's good to have a couple of months, of reserve. But yeah, as you get older, and you have other types of assets to draw from, it may be less.
Yep. That's good.
Hey Bill, I think sometimes too, you mentioned this, but lots of times people know when they need to kind of adjust their plan, and especially as it relates to their estate plan, because they know when they had a big major change in their family, a life event, like you mentioned, um, but there's also changes in their assets that may require some tweaking of their financial or their estate plan or their asset protection plan. And then also they want to kind of monitor changes that might happen in the law. So those are all things that might necessitate a change in their financial or estate plan.
Yeah, absolutely. And I think this next year is going to be a big one for kind of updates, because there are quite a few. I mean, if you guys were here for our last webinar, there's quite a few tax law changes that are happening, and not just this upcoming year, but in the coming years. And so incredibly important for folks to stay on top of their financial planning and tax planning as well. So.
You have another question.
Yep.
Very popular today on this one. All right. They want to know what do you recommend that a client keep in cash, i.e., how many months worth of expenses should a client keep in cash?
Again, great question. I think, at a minimum, we always talk about 3 months, right? We need to have 3 months of reserves, but that number can change a little bit too, right? It also look a little bit different if you're W-2 versus self-employed. If you're, or if you're partial, you're W-2'd and 1099, and maybe you got, 50% of your income's coming in W-2, 50% is coming 1099, or 75% is coming 1099, so there are different factors to look at, but I think it's so there's not really a cookie cutter approach to it, but I always tell people, at a bare minimum, you've got to have 3 months of just 3 months of runway saved, set aside in cash. Now, you don't want that money to lose purchasing power, right? So you do want to have it in some kind of a high yield savings, something that can fight inflation, but you also don't want to have too much in cash, right? You don't want to put so much money in cash that you're missing out on opportunities. And so now there's a difference between, having it in an account that I can access today if needed. But still exposed to, let's say, the market, or that's exposed to to opportunities for gains that aren't just going to fight inflation, but but outpace inflation, right? And so, but at a bare minimum, three. Most people are going to advise 3 to 6. That's what most people will advise. I think for some people, if you're purely like, if you're an emergency room doctor, if you're in emergency medicine, purely W-2, no RVUs, no bonuses, you can probably get away with 3 months of cash set aside, right? Whereas if you're purely a 1099 anesthesiologist, you may want to have closer to 6 months set aside in case, the group that you're signed with loses a contract, or or something of that nature, where you're scrambling for a month or two. And so it looks a little bit different, but 3 to 6 months is kind of the norm. I think any more than 6 months is a problem. I think it needs to be in something that's working towards building long-term wealth. So
We have also asked, Bill, can you help me prepare a financial plan? How do we get started, and what documents should I pull together prior to meeting with you? What will it cost me to do a financial plan?
Yep. So great questions. And so um, we always are going to start with the strategic tax blueprint. I think that's the most important area for physicians or high income earners to begin, is looking at how different ways that you can minimize your taxes, because that's generally where we're actually able to find some of the most money for clients to be able to attack building out their wealth plan as wanted. Now, from there, I do have my own individual planning process that looks, that's like complementary, as a supplement to the strategic tax blueprint, right? Because I am not a tax attorney, nor will I ever claim to be one, nor will I ever claim to be as smart as David Auer. So he handles the taxes. I handle the other areas of the financial planning. But what I found, though, is, through my process, because I take my clients through a 4 or 5 step process with my own financial planning, to talk through about long-term goals and vision that you have for yourself. And then we talk through protection management. We talk through wealth building. But, a lot of the planning process can actually hinge a little bit on what David and his team are able to do in regards to taxation. And then again, there's no cookie cutter plan with me. And so I'm not like I hate to speak down upon them, but like the 98.999% of quote unquote financial advisors that are out there that just put together some kind of a cookie cutter or whatever. So every single one of my clients get a very customized approach from me. And so as far as the financial planning fee goes, it looks a little bit different from client to client, because different clients have different needs that take more time or less time. And so it's all, but The consultations initially on the front end are complimentary. And then from there, we would look at actual client engagement, and you would know what the fee would look like on the front end before we ever entered into a client engagement agreement. Did I answer all the question, Angie?
I think you did, yes.
Okay.
Yeah, covered everything. I don't see that we have anything else, so I think that's your grand finale.
Perfect. There we go.
Well, thank you everybody for joining us today. And thank you, Bill, for your expertise.
Oh yeah, thank you guys so much for having me. It's always always a pleasure, privilege to get to talk with physicians and have an opportunity to just teach a little tiny sliver of financial literacy to you guys.
And just a reminder for those that are attending today, we are going to send out a recording later. So you can watch it again, and then we'll also send it to those that missed it but did sign up.
Awesome.
Thanks, everyone.